Thank you very much for joining us again today for this new discussion on supply chain risk. So my name is Max Henry, as some of you know. I'm running the organization, the Global Supply Chain Council, and I'm very, very pleased again to have some interesting panelists and industry speakers to get together to discuss a very hot topic, which is supply chain risk. We call the event Staying Ahead of the Curve, Redefining Supply Chain Risk in 2025. And in this discussion, which is just going to last just 55 minutes, you're going to hear this different voice, perspectives, and hopefully some interesting points on what's going on when it comes to supply chain risk in APAC, the Middle East, and also from Europe. So this discussion, we want to make it as interactive as we can. If you have any question, you can click on the question mark button located at the bottom of the screen. We will take those questions as they get posted. We will prioritize those questions, and hopefully we should have an interesting discussion. I'm joined today by my co-host, Snigdha Verma, who is with me and who's going to support me in driving the discussion and hopefully getting some interesting talk from how are you listening that today? You're muted. So I don't know if the others can hear, but no worries. We'll come back to you. Okay, it's working. Go ahead. Yeah.
Hi, everyone. Thanks, Max, for the opportunity. And I'm Snigdha. Just a brief introduction. I've been a 17 operations and supply chain professional for 17 years. I've led procurement and transformation projects, and I'm happy to hear views on supply chain risk and how we are staying ahead of the curve from the industry panelists.
Great to have you again, Snigdha. And again, if you're just joining us, I want to remind everyone that this discussion is going to be interactive. So if you want to ask questions, you can do so by clicking on the question mark located at the bottom of the screen. So maybe we get started by a round of introduction with all the panelists. We'll start maybe with you, Arnel, and then we go around the screen to get everyone to introduce themselves. Go ahead, yeah, welcome.
Yeah. Thank you, Max. Hi, everyone. I'm Arno. I'm the VP Logistics for Ace Hardware Philippines. I have about 26 years of supply chain experience. And as you know, Ace Hardware is the oldest and largest hardware cooperative worldwide. We have about 5,800 stores globally. And in the Philippines, we have about 240 stores under the SM Retail Group. Glad to be here. Thank you.
Great. Good to see you. Now we have Paul also joining. Hi, Paul. Go ahead. Yeah.
Hi, Max. Thanks for the opportunity to join you today. I'm Paul Wright. I am the Merchandise and Supply Chain Director at Christopher Ward. We are an Anglo-Swiss watch brand based in the UK. We're the UK's largest watch brand. I'm based in the UK and Switzerland, but have spent 26 years out in Asia at the sharp end of supply chains.
Great. Good to see you again, Paul. We have Nanda also joining us. Go ahead. Welcome. Make sure to unmute you.
Hi, can you hear me?
Yeah, all good. Yeah, go ahead.
I'm Norway-based supply chain and operations executive with over 25 years of experience from Mitsubishi, Rolls-Royce, and Cleantech, and now focused on building resilience and transformation in global value chains.
Great, fantastic. We also have Vijay joining us. Welcome, Vijay. Go ahead. Yeah.
Hi, Max. So I've been working for the last 20 years, majorly into supply chain. Currently, I head the S&OP and business planning for Henkel Adhesive Technologies. It's a chemical company. I take care of the IMEA region for packaging and consumers division. Thank you.
Good to see you again, Vijay. Then we have Adarsh as well. Welcome, Adarsh. Make sure to unmute.
Thanks, Max. Thanks for the opportunity. So myself, Adarsh Appukuttan, I'm the global head of corporate procurement for Sirva, and I also manage the India operations. So we are a relocation player with a moving business as well as a relocation business, and a part of consulting business. So happy to be part of this panel. Thank you.
Great. And then we have Craig also. Welcome, Craig.
Yeah, hi, Max, and thanks everybody. Craig Alveston, I'm based in Melbourne here in Australia, at the bottom of the world compared to some of you guys. which presents some unique challenges from a risk perspective. I'm principal and CEO of LogChain Partners, specializing in supply chain management, but my career is 25 years in supply chain and logistics, half of which has been in industry. Spent a lot of time in the 3PL sector, buying, acquiring and growing 3PL businesses. But these days, my consulting is really around supply chain strategy, operations, and technology across retail, industrial, mining, and also the 3PL sector. I do a lot of work in that space as well. So really great to meet everybody here on the call.
Okay, great. I see a bunch of people just joining us. Again, this session is all about supply chain risk. Feel free to ask questions at any time by clicking the question mark button. We will take your question as they get posted. So hopefully we can make this discussion very interactive. Let me get started with a very general question. Again, when you think about supply chain risk in 2025, what do you think has changed the most compared to like 5 years ago? Are the risks truly new or just all risk in new forms? Again, this is for anyone. Anybody would like to start here?
I'm happy to kick it off, Max.
Yeah, go ahead.
Well, I think, if we sort of wind the tape back 5 years ago, we were just going into COVID lockdowns, and they had obviously a profound impact for, not just during that period, but subsequently, and it took a long time for supply chains to get back on their feet. And I think what it highlighted was that, risk really wasn't high on the agenda for a lot of businesses, and, because everything was pretty well set and forget. And what we saw and what I think it highlighted was that that companies with poor planning processes, poor systems for sensing and responding to changes in their supply chains, that was really exposed, right? And I think what's happened and what's changed since then is I think that was a wake-up call for a lot of businesses. And now they've invested a lot in the systems and processes and their supply chain sourcing to improve their resilience and also their agility, which is their ability to respond to shocks to the supply chain. And as we've seen over the last 2 or 3 years, with the war in Ukraine and what's, that's impacted things like, fertilizers and other basic inputs to a lot of things. I think, the recent sort of trade wars, I think the companies that have invested in those things are now sort of reaping the benefits, so to speak, and then other businesses continue to struggle. So I think, the risks are becoming, I think, more frequent, but I think, and also, I think harder to predict in a lot of cases. So I think you've got to manage risk more holistically, is my view, but be prepared, and get those strategies in place. And I think that's what a lot of businesses have done and changed. And technology is also playing a massive part in the ability to sense and respond to those disruptions.
Yeah. Okay. Thanks, Craig. Yeah, Arnel?
Thank you, Max. I think I'd like to double down on what Craig has just mentioned. I couldn't agree more. Compared to 5 years ago, I think there's a new normal now, so to speak, when it comes to the rules of the game. And while before we were quite surprised with what happened when COVID came in, I think as of today, we're preparing ourselves better in terms of risk assessment and risk management. And further, I would say that it wasn't easy. It was messy at the start. It was messy in the middle, and it was still messy in the end when we were finally able to recover after COVID. There was a point wherein we really had to accept the fact that there is really no option but to accelerate our digital revolution game. Whereas before, we knew that it was something that was coming, but we were still sitting comfortably where we were back then, striding with our own pace. So I think today, if you've heard of the VUCA world, which is volatile, uncertain, complex, and ambiguous, there's a new definition already that's coming in, and we call it the Navi world. This was, I think, popularized by EY or Ernst & Young, which basically defines nonlinear, accelerated, volatile, and interconnected. So as it is, from that definition itself, I think it goes without saying that risks today are coming in with more frequency, with more intensity than ever before. So much so that I think they're multidimensional now. It can come from anywhere, as mentioned by Craig. Before we were dealing with the pandemic, and eventually we were suddenly dealing with geopolitical tensions, supply chains were stopping, halting down, and even at some point we had some Red Sea issue as well. So anything could happen. So today, I think more than ever, there's more emphasis in terms of putting value in terms of risk assessment and management as well. That's all from me, Max. Thank you.
Thank you, Arnold. Yes, Paul, yeah, go ahead.
I think for me, the risks are very similar, and it's just the different. We've changed the lens to a certain degree. So, a reliance on one country before was around labour and costs, and now it's more geopolitical. Supply chains have got incredibly lean, again driven by costs and taking costs out and a risk of cost and competitive. We now see that as a disadvantage and needing to build more resilience, managing supply chains and stock to the day is no longer really possible. And visibility, again, sort of labour, the risks of labour, and now, again, geopolitical risk, understanding where your materials are from and having a better vision down through the supply chain. So similar topics, just a different lens from my perspective.
Okay, thank you. Adarsh? Make sure to unmute, Adarsh. Yeah,
Sorry. Yeah, I couldn't agree more with Paul, right? And I think what's really changed is not that the risk has changed. It's the same old risk, but they have become faster, more interconnected. It's more systemic, right? Because anything and everything that we were looking in a few years back in silos is now amplified by the climate volatility, the AI-driven systems, and even the geopolitical fragmentation. So while many risks are old in nature, I would say the context has shifted, right? So today, an AI algorithm failure or a carbon border tax can disrupt the supply chain to the same extent as a port strike can, right? That's the parallels today, right? So the real shift to me is in scale and complexities of interdependencies, I would say.
okay, yeah, Vijay, yeah, go ahead, yeah.
Yeah, just to add, I think pretty much points are covered by the co-panelists. I think one aspect I think is also driving is the focus on the environmental factor. I think while the geopolitical trade wars are now normalized, as Artel and Craig and Paul and others mentioned, the sustainability factors are putting an add-on pressure, and that kind of is also pushing the innovation to another direction. So that's just an added complexity over and above.
Okay, yeah, thank you very much. Snigdha, yeah, go ahead, yeah.
Yeah, thanks, Vijay, on your viewpoint. So, in today's perspective, when we are looking things in the interconnected world, what is, from your perspective, any one of you in the general panel, that is the biggest risk that that's keeping you awake at night today, be it geopolitical, ESG, climate, cyber, or maybe talent?
Yeah, I think.
Yes, Vijay.
Yeah, with the panel's permission, I can take this up. I think for me, what we are facing right now is an underestimated risk of talent. While everything is changing, the expectations are changing, the consumer behaviors are changing, and with the digital dependence coming into the picture, the focus on digital, ESG, AI, the skills, the basic skills required are changing as well. So no more we are accepting talent who think AI as a competition to their own jobs. So I think for me, talent is really, really underestimated, and that keeps me awake. Think that.
Thank you, Vijay. Adarsh.
Yeah, so all of these to me is intervened, right? I agree with Vijay that, right, there is definitely, a talent is something that is of huge risk at this point in time. But to me, I think the geopolitics is a multiplier risk today, right? So this kind of the conflicts, the sanctions, the trade realignments, they just don't disrupt your logistics. They just amplify your climate, exposure, your fight for talent in the market. So basically, it kind of goes back and triggers, like it's like it's a ripple effect, I would call, right? What the geopolitics can do onto the other risk factors. So if you ask me what is going to keep me awake, I would say all of these risks. Predominantly, anything to do with talent and geopolitics is something that is, of late, I'm seeing that to be top notch and very, very competing space when it comes to these two aspects, right?
Fair enough. Paul, you raised your hand first, so.
Thank you. For me, it's geopolitics. It's what's the unpredictability nature and the impact that can have from where you're sourcing all the way through to where you're selling, and it can have an immediate impact on the business. You can wake up in the morning and the goalposts have moved. So it's geopolitics every night.
Fair enough. Nanda, how about you?
Yeah, for me, it's not geopolitics or climate in isolation. It's the interconnection of risk. That's the biggest risk today. For example, cyber plus geopolitics plus supply concentration hitting together. That's what keeps the leaders awake nowadays.
Right. Anyone else to add to this?
And we
hello.
Yeah, Hannah, go ahead now.
Yeah, thank you, Max. Snigdha, I'd like to add, and I think I'd like to agree with Paul right over here, because as we've seen today, especially with tariff wars, the trade wars that we've been experiencing the past few months, anything goes. It's very volatile. One day you have this tariff implementation, the next day it can be reversed. So I think nothing could prepare any supply chain practitioner, even the seasoned ones, when it comes to dealing with this surprises when it comes to geopolitics and tariff wars. Thank you, Snigdha.
Yeah, and we have actually a question just to interrupt what we talked about. I think it's related. So let me bring this to a screen. Aisha is asking, so geopolitics change so fast. How do you avoid overreacting to every headline? I think it's a good question.
Yeah, I'm happy to answer that one, Max. For me, and sort of building on the last kind of question, which is, this is not a point in time. I think this is absolutely a change in the world order and global trading relationships, and that system's been built over 50 or 60 years, right? But I think we are looking at a tectonic shift in the global trading environment, and I think overreacting to the headlines. I think every headline is relevant. It's a bit like the stock market. We know that a crash is coming, so to speak, but the question is how do we prepare ourselves for that, and what are the strategies that businesses need to be putting in place to prepare for that? And I think it's not just one, but it's a range of scenarios. So for example, a lot of people are now adopting a China plus one strategy, so they're sourcing from China, continuing to do that, plus what's an alternative source of supply. Why? Because I think China is clearly going to continue to dominate in a lot of areas, and they're also, I think there's going to become a time when China will restrict other countries from being able to produce the things that they produce with critical minerals and rare earths and these sorts of things. So you kind of need to have that plus one strategy. And I think the thing that's really exercising people's mind now is how quickly can we put those new arrangements in place? Because again, a lot of those supply chains, whether it's offshore manufacturing and sourcing, again, that's been built and refined over many, many years. So how quickly can we diversify our supply base, diversify also potentially our trade, the trading channels and our shipping channels that we're coming through to where we need to get them to, and then looking at our domestic supply chains and saying, what decisions do we have to make around how much inventory do we hold, where do we hold it, those sorts of questions. I think how quickly can we change to a more resilient platform is the thing I think that's really driving it. And I think that this is not, I mean, the headlines are indicative of a broader trend, and the world has changed. And if people think that it hasn't, then they're clearly not reading the tea leaves here, so to speak. So yeah, the global trade order has shifted, and that's I think that's an absolute truth. It's we're not going back to the way it was.
Definitely. Yeah, Paul, you wanted to react on this, yeah? Make sure to unmute, yeah.
Yeah, for the question, I think, you know, having a clear strategy in place and taking the decision, and, you know, is the change a tactical short-term decision, or is it a, you know, impact on your long-term strategy? And then how do you react to that? If it's tactical day to day, you take a shorter term reaction, or you let it roll. If it's longer term and strategic, you know, you take longer time to sit down and look at it, but be very clear on where the strategy is and where you're heading, and deal with the changes in through that lens.
All right.
Yeah. Anybody else would like to react on that question? Yeah.
Yeah,
Just
you
a
know,
last. Sorry, Adarsh, go ahead.
Yeah.
Yeah.
Go ahead, Vijay. Vijay and Adarsh, I think that you can take the lead after you.
Adarsh, please.
okay, thank you.
Go ahead.
So
Go ahead,
I
Vijay.
think I think it is for me. It is more about responding and just going back to what just Paul said, right? See, your strategy is not going to be, deviated because of a headline, right? So, not every headline deserves a supply chain redesign, is what my thing is, right? So there is noise and there is facts out there. So tuning noise into structured monitoring is what I would say is the best response that we can give to any of these situations, because we get to see this on a regular basis, and then from there kind of formulating your response plan is the best approach. At least that works for me, and I think that really helps, because if you have to kind of react, you keep on reacting, because there is today something is there, tomorrow there will be something else. So I would rather have a monitoring of those scenarios and evaluate them as to what is going to shape into a problem down the line, and then probably respond in line with my strategy, right? Because none of these in the instant phase, demands a restructuring or a shift in strategy, is what I think.
Okay, thank you, Adarsh. Yeah, Vijay, quickly.
Yeah, I think I would just want to add on what Adarsh said. For me, I think every headline is now an opportunity as a supply chainer to simulate the possibility. The more you are faster and efficient in simulating those possibilities to come out with the broader parameters that's going to hurt your business, or maybe give a simulation arithmetic that could give you the impact on your revenue, on your bottom line, on your customer service, so on and so forth. That is going to now help, because as my co-panelists rightly pointed out, that it's about your capability to respond as soon as possible to the VUCA environments, because they are just coming faster than ever before.
So thanks,
Okay.
Vijay. Thanks, Vijay. So as we talk about the headlines and reacting to it, and briefly talk about the monitoring, how is your organization, and this is a question to the general panelist, that how's your organization currently approaching risk management, given, is it reactive, proactive, or somewhere in between?
Anyone?
Yeah,
Paul?
Paul.
I can comment a bit. So I think when it comes to the risk thing, the risks haven't disappeared. What's new is the speed of transmission, as we have seen the other panelists speak about it. For example, a disruption in Asia shows up in a Nordic boardroom within hours, not months. And taking a piggyback on the question there, so most of the organization I see are still in a reactive mode. They try to fight the disruption after it has occurred. So it's not about just supply chain being proactive. or reactive. I think it's now becoming more of operational level aspect where processes, early warning signals are to be embedded in the S&OP processes. So most of the organization are trying to, instead of building it, the resilience has to be built in, not something which has to be bolted on. So every tool, everything which is available, organizations are trying to use it after things have happened. So this is still not changed. Otherwise, that's the reason we have so many questions asking about how are we overreacting. So the reaction has to stop. We need to, organization has to be more proactive to say, is this something which can happen? So they have to sense it before it happens. And we are not there yet. We are not there yet because disruptions will not stop. It will come in different form, in multitude forms. So organization have to change their complete outlook and also the skill sets of the people in terms of being proactive, in terms of seeing everything as an opportunity and be ready, prepared for it. I think we have a lot of work to do on that.
That's a wonderful point on being how you build that proactiveness. Paul, would you like to, you raised your hand, how about you reacting on that?
Yeah, I would sort of build on that as well. We're pretty reactive, but we're a fairly small organization. And by being reactive, we're also able to be more agile and react quicker. We haven't got the resource to plan the scenarios and have everything sort of ready to go. Having worked in bigger organizations where that's the case, it takes a lot more to turn the container ship than it does the speedboat. So as a small organization, we are reactive, but we see that more as a strength than maybe a weakness that would be typical of a strategic approach.
Okay, thanks. Paul, Vijay, you wanted to add to this?
Yeah, I think, of course, no option. We all are moving towards the adaptive modeling, but I think the discussions in the boardroom right now for any company is how do we move towards the adaptive playbook? Very fine line between the proactive and the adaptive versions. So as I said a while ago, it's not about predicting the next scenario or the next risk. Is about building that optionality and capability in the system to respond to it as soon as possible. Yeah.
Fairly so. Thanks, Vijay. Arnold, you wanted to add to this as well.
Yeah, thank you, Signa. Well, Ace Hardware here in the Philippines is part of the SM Retail Group. It's the biggest retail conglomerate here in the Philippines. So I'd like to say that for now, our stance is, I think, more blended. So it's a mix of reactive and proactive. As a big retailer, one of the things that we promote and support is obviously collecting big data. And from that big data, of course, the pursuit, of course, is to somehow harness trends, be able to produce insights, and basically get ahead of the curve. And so that helps in terms of predicting, in terms of forecasting certain things, and making the organization more proactive in a way. But unfortunately, as we've just discussed and as mentioned by my co-panelists, we really have a lot of data today, and there are really a lot of moving parts, and risk can come in many shapes and forms. And there are many times, like mentioned again by my co-panelists, that many things slip into the cracks, and basically we become reactive in that fashion. And so I think even if you're a big corporation today, agility, flexibility, adaptability, they're all very important attributes to have, because in as much as you have data at your disposal, your ability to act on that data still matters. Thank you, Stigda.
Thanks, Arnold. Craig, how about you adding to this? I see you raising the hand.
Yeah, I think for me, what I'm seeing, the number one strategy that businesses are adopting is closer collaboration, particularly with their key and strategic providers. And really, you're a customer of theirs, and you're just as important as their suppliers are, right? I mean, you can have issues in your business that can disrupt them. as much as they could disrupt you. And so it's collaboration and really understanding, well, what risks are they seeing in their supply chain, what risks to their supply, and therefore you as a customer. So getting tighter collaboration rather than just an arm's length transactional relationship. And things like, I think the question was around also, how can we control costs? Well, if, for example, one thing, if we can understand a lot better than what we do today, what inventory are our suppliers carrying? If they're carrying higher levels of inventory, and we're carrying high levels of inventory, if you look across the chain and say, well, actually, that doesn't make kind of any sense. Maybe we can reduce our inventory levels, knowing that, maybe they can hold it on our behalf, and knowing that we can draw on that. And then the question is, what the lead times are to be able to get supply. Whereas, a supplier might be running very lean and not carry large stock levels. Therefore, it might make sense for us to run higher stock levels. So it's really having that collaborative conversation with your critical and key suppliers. That includes your shipping lines, and I think that's the number one strategy I'm seeing that is being employed. Having a dialogue, having a conversation of not just what's your price, what's your quantity, when can you get it to me, but actually understanding, well, how are they managing risk? What are they seeing? What can you do as a customer to help them to manage their risk better? And I think that, so it's really looking at the risk across the network or the ecosystem that you play in, not just, within your little piece of the chain, so to speak.
Thank you, Craig. That's a wonderful point. Over to you, Max.
Thank you. All right. So we have Ruth actually just joining us a little bit late. Hi, Ruth. I'm not sure whether you can hear us. We were waiting for you, but you're finally here. So good to see you. And you're more than welcome to join the discussion. So let me take maybe some question here. We have some interesting question coming up from your audience. And I'll get started with this question from Louis, who's asking, with supply chain risk becoming more frequent, interconnected, and costly, what are the most practical strategies leaders should adopt to build resilience while still controlling cost? Anybody would like to jump in and answer that?
I can comment, Max, if it's okay.
Yeah, go ahead.
Yeah, I think it's more about shifting the measuring resilience after disruption to anticipating it. So this is what it's. I would look for leading indicators beyond logistics KPIs such as supplier financial health, sudden change in shipment patterns, or even chatter in local markets. These tell us disruption is coming before the containers stop moving. So I keep saying resilience can't be a dashboard you check after the fact. It needs to be woven into the cadence of weekly operations, the same way we track OTIF or inventory turns. So as I said in the earlier question also, it's mostly about being proactive and then collaborating with the external factors. So risks are always coming from supplier, supply chain, logistics. So how are we investing in the collaborations? How do we ensure the visibility is becoming better and better? And I think that's the fundamentals upon which the strategies have to be built by organizations, rather than wait to see on the dashboard and then react. So there is no easy way to answer this question, but I think I tried to answer as much as possible.
Okay. Yeah, Anil.
Thank you, Max. So I'll answer this as simple as I can, Max. I think the fundamental meaning of strategy is having more choices or options. And there was a point mentioned by Nanda in terms of having visibility of what's happening, being able to gather information. I think that's very important in all of these things. But one point that I'd like to drive at is that you don't put all your eggs in one basket. So you don't go from one extreme to the other. Like pre-pandemic times, we were practicing just-in-time logistics. We were maintaining lean inventories, and all of a sudden, these concepts were broken down. And we started to entertain reshoring, localization strategies. But coming off from what I said, from one extreme to the other, I think there's going to be a delicate balance of these options. We need to be open-minded when it comes to considering how to get from point A to point B. I think that is what is going to be very important. We know where point A is, and we definitely know where the destination will be. However, we need to be a little bit flexible, versatile when it comes to adopting how we will get to point B. And that might entail having a combination of solutions. It can be probably tweaking some of the replenishment parameters. If you're changing a source country, let's say from China, you're getting somewhere nearer in, let's say, Southeast Asia. And you have to also tweak some of those replenishment parameters like min-max, reorder point, frequency, and even lead time. So again, you just have to be open and flexible to these options. And as long as you're able to still get to your destination, which is point B, then I think you're still good. Thank you.
Okay. Anybody else would like to react or respond to this question before we move on to the next one? No? Okay. All right. So let's move on to the next question. And let me bring this on screen again. Okay, we have a question from Nadia who's asking, what's the best way to monitor supplier risk beyond tier 1? Most of us struggle there. Any tips or advice to look at evaluating a risk at beyond tier 1, so tier 2, tier 3 and beyond? Yeah. Yeah, Paul, yeah, go ahead.
I think for me, the first point is quantifying what the risk is in tier 2, tier 3. Is it geopolitical? Is it cost? Is it reliability of supply? Is it reputational? So identify what the risk is you want to monitor. And I still think, it's being out there and understanding it and talking to people. I think it's boots on the grounds to a certain degree. It's asking questions. It's mapping. It's sort of old school detail. But I think the key bit there is to start with, identify what the risk is that you're wanting to monitor, because I think that has changed a lot in tier 2 and tier 3.
Yeah, makes sense. Yeah, Ruth, I saw that you raised your hand. So would you like to answer? Yeah.
Thank you, Max. From my point of view, how to monitor the supplier risk beyond tier 1 or 2 or 3? Same with Paul. Yeah, it depends on what kind or what point you want to identify. But from me, what I have to do is, if it's possible, is the best way for you or for us to go and visit to the vendor directly, especially their factory, so we can know better their profile, their performance, how big and how is their capacity to supply or to provide our company. So it's better for me, from my point of view, it would be better if we could go directly, have a visit offline to the vendor's facility. Thank you.
Thanks. Yeah, Ruth. Yeah, it makes sense. Yeah, Craig, you wanted to respond on that? Yeah, go ahead.
Yeah, I think that's just building on my last point around, collaborating with your key suppliers and partners and understanding, who are their kind of key suppliers and partners. So that's a conversation which we sort of touched on. But there are also tools out there available that actually do this work for you, where you can analyze things like invoicing and information and it can trawl across the dark web and a lot of other stuff that can actually then dig into actually understanding who those kind of key suppliers are, and then can highlight, there might be a particular key supplier of a particular key component. You might think you've got diversification with 3 or 4 suppliers, but they are all getting a critical component from a single supplier. It's called supply chain illumination, and there's 2 or 3 different tools out there in the market that can do that for you, and it uses AI, the dark web, and some smarts in terms of looking at your supplier information to then look beyond those guys using. It's quite sophisticated technology, but there are tools out there that also help you to do that. So I think to Paul's point, it's shoe leather and conversations, but there's also some pretty interesting tools out there that can also analyze your supply base and look 2, 3, 4, 5 layers into your supply base, which is quite interesting technology.
Okay, Adarsh.
Yeah, most of the points have been covered, I think. But the only thing that I would add on is, supply mapping and network transparency becomes key in these kind of scenarios, because your tier one risk is something that is very visible, whereas your tier two and tier three is what usually gets you blindsided. So having a good supply mapping from your tier one down and having that network transparency really helps. And to going back to Craig's point earlier, there is a lot of options and tools available that can give you that level of transparency, give you data driven signals which can help you manage your risk in those segments, and then you can actually adopt a strategy which whatever aligns with your industry, right? And but I would say always base it on the risks that gets flagged from your network monitoring and your analysis, I would say.
Okay. Anybody else would like to take this?
I can just add a comment, Max. I think that the key here is we have to move away from monitoring supplier risk. It's all about managing and collaborating. So that means you need to we need to develop the visibility and transparency in the entire supply chain, so that it's not it's also an investment when it comes to visibility in the tier 2 or tier 3. So we need to collaborate in such a way with our tier 1 that they also take up the risk and the investment to monitor their tier 1, and the same goes down the line. So that means it's co-investing in risk management. So instead of sitting and monitoring, we need to develop a partnership where each of the tier manages their next tier, and the visibility is moved up front, so that we are able to discuss proactively and take actions. That's the only way I've seen. This is from my experience. We sit and try to monitor and try to gather the risk. We miss out on many of the things which will hit us.
Okay, all right, let's move on to the next question. We have more questions coming in. And again, if you still have a question, it's still time for you to click on the question mark, but let's push the next one. Yes, Nita, yeah, go ahead.
Yeah. So as we are talking a lot about resilience, how are we measuring it in like real terms?
Good question, yeah.
Any
I can
strategies?
answer a bit.
Yeah. Thanks.
I would have also asked the same question to the panel if I was participating, because it's so complex. Thing about resilience is to understand. It's a very nice term, the nice jargon used everywhere, probably overused. Resilience is how quickly a company can stand back on its feet. So it's not. It depends upon what are your objectives. Where do you want to stand? Are you going to continue your suppliers? Are you going to have your consistency on your cost? It can be resilience, can be on any aspect of the company. So that means you need to start from the fundamentals as to why are you in this? Why have you started the company? What's your objective of the company? And if you are able to continue to do that with the minimal disruption, then that's the resilience. So it's just the time taken to minimize the disruption, I could say, or time taken to come back into the consistency or back to the normal state, whatever the company was. And it varies from company to company. There is no one single tool or formula you put in and you get a measure of resilience.
Thank you, Nanda. Adarsh, I see your hand raised. Would you like to add to it?
I would completely agree with Nanda on this, right? Because this is a very abstract concept that has been doing the rounds for ages, right? The time immemorial we have been talking about resilience, right? And I will answer this in two parts, right? One is the question that comes from a pure ops standpoint, and I couldn't agree more with Nanda. that, right? It's all about, you getting up and, being able to kind of run the show, right? But I'm gonna, divert to the second part of that, right? Now, this is a question that I often get from the board, right? This is a very common board question. Every time you get in front of the board, they ask you, how do you measure it? Now, from a board standpoint, when I kind of look at it, and this is completely different from the ops take, right? Is about, you can actually present resilience in multiple manners, right? The key ones being time-based metrics, like your time to recover, your time to survive, then going back into your financial metrics like revenue at risk, right, which is the most important portion of it. The cost of disruption, again, risk adjusted cost to serve, right? There are quite a few parameters based on which we can actually quantify this. Now, is it going to be something that can be served back to an ops standpoint? No, these are two different treatments for the same problem, right? Because the board is not going to kind of buy your take that, right, getting back on foot is what resilience is. But from an ops standpoint, that's what matters to me, right? But for the board, I think, these would be some of the metrics that you can use. And again, there are operational metrics that you can use, largely around buffer efficiencies, your critical supplier efficiencies and things like that. But, if you can, map out these key parameters into, map out these key parameters, I think, you can quantify to some extent, at least to kind of convey the kind of position that you're taking from a resilience standpoint. But yeah, I would agree at no point, there is a complete definition or a complete, or a foolproof manner that you can define that.
Thank you, Adarsh. Arnel, your hand was raised, so would you like to add to that?
Yeah, thank you, Signa. So I completely agree with Nanda. It's just getting your feet back on the ground. And again, Adarsh made a very good point that this is something that's quite simple, but also very difficult to define. And another point that he made is that it should be quantifiable. So let me try to crack this. One of the things that I believe is very important when it comes to resilience is being able to operate business as usual. And in the discipline, in the art of business continuity planning, there are some tools and ways on how we measure that. And I believe as part of being a lag indicator, business as usual, meaning we should be able to define that as maybe 100% in terms of operational capacity, in all the machines are working, all of the trucks that we want to dispatch are fully dispatched. But then again, there is what we call the lead indicators. And as I mentioned, in terms of PCP, there are some measures that we use to facilitate in terms of looking at the picture of success. One of them is the recovery point objective, or RPO. This simply means this is the amount of data that we're willing to lose in cases that we have some disruptions. And there is another thing, the recovery time objective. Again, this simply means the amount of downtime that we're willing to shoulder when it comes to operations as well. So I think success basically will be defined in terms of how fast we can get back on our feet. And it should be measurable, as I mentioned, through the examples that I've demonstrated, like RPO and RTO. So I think we can do something like this for the whole supply chain as well. We just have to be imaginative or creative in looking at how relevant these measures will be for the operations. Thank you.
Thank you, Arnel. Anyone wants to add to this? Or okay, so I have a question around board as we talk about board references. Supply chain risk is still considered very operational, right? Like until the disaster strikes. And while as we are talking about the board level conversations and making reference about RTOs and RPOs, how do you translate these into board level languages and getting that kind of attention? Because as we speak, RTO, RPOs can sometimes be a little bit operational.
Yeah.
Craig, you raised your hand.
Yeah, I think the short answer to that question is it's about governance, right? So directors have a fiduciary duty to their shareholders, and it's about managing the risk on behalf of the shareholders. And so if you put it in those terms, in terms of saying, right, well, what's the probability and consequence of a disruption, and particularly financial consequences, those are terms that the board understands. So what's the share price impact, or what's it going to do for shareholder value if these risks aren't managed right? But there's no free lunches, of course. You can have a completely risk-free supply chain, but you'll go broke, right? So it's about being able to understand the probability and the consequences of those risks, and then what do you put in place to mitigate those risks? Do you invest to build resilience? Do you have mitigations or other controls that can manage the risk? So you can either try and harden your supply chain, but that obviously costs money, or can you have strategies and scenarios in place when the disruption happens? And I think to Arnold's point, then what can you then quickly mobilize to get back on your feet, right? It's a bit like and I do a lot of work in the power and utility sector. You've got electricity transmission lines, storms happen, right? You can bulletproof the network, but that will cost you a huge amount of money to do that. Or do you have the ability to quickly roll out crews with the right spare parts and the replacements to rebuild the broken power lines when the storm does come through? So it's about understanding, what are you prepared to invest, where you need to invest, where those single point sensitivities might be. But then how can you actually then quickly deploy resources to repair the supply chain, so to speak, when the disruption happens? But coming back to the point, so it's about talking about it in fiduciary terms, in terms of the, what directors understand, which is shareholder value. Where do you invest to manage that risk, right? Business is risky, and where do you invest in order to manage that risk and or have plans and strategies in place to mitigate that risk? And that's the language that boards understand. So if you're saying, hey, we need to go and put in more inventory, that's going to cost a bunch of money. They go, well, let's just, how am I going to get a return on that investment? You say, well, the return on the investment is, and there's financial ways of measuring, Black-Scholes or CPM measures around the risk and the probability of disruption and what that means for shareholder value. So you can actually quantify the financial cost of failure based on probabilities and different scenarios and outcomes. Hopefully that makes sense. But I think that's the language that boards understand.
Definitely. Thanks, Craig. That was a great point on where to make an investment. Nanda, you want to add to this, please?
Yeah, I can add. I agree with Craig. Boards don't engage with disruption stories. They engage with numbers and scenarios. When you translate supply chain risk into EBIT impact or a cash exposure, it becomes a board agenda item. The most effective thing I've seen is how you frame the risk. For example, if you attach a particular risk to a lost customer trust, for example, that language cuts through financials and puts supply chain where it belongs, in the boardroom. So it's all about quantifying and then articulating the risk in a way. But most important, I would say, is in my experience, I've not seen this happen often. So most of the supply chain risks and the operational risks are discussed at a very transactional level. So it's an art for supply chain leaders, I would say, that they need to translate that and get the risk heard in the boardroom. So that's important, so that the investment decisions or the backup support that comes across clearly.
Thank you, Nanda. I'm conscious of time, so 2 more minutes we've got. So Adarsh, you, and then probably Vijay, I'll take your opinion on after Adarsh. And
Yeah,
Craig,
so
you also have raised. Okay.
Yeah, so again, I kind of agree with Craig and Nanda on this, right? Because business value at risk is what would the board understands. So, they are not really engaged with the truck delay, but rather the business value at risk. So the way we do in our spaces, we talk about supply chain risk in terms of revenue protection, market access, regulatory exposure, and reputational impact. These are the segmentations that we use to kind of represent it, so that it moves away from being an op stock to being an enterprise risk management. So I keep it, that's pretty much from my side on that.
Thanks, Adarsh. Vijay? You wanted to add to this?
I pretty much agree with whatever the co-panelists say. I just want to add that it brings us back to the processes that we lay in our regular routine S&OP cycle as to how can a simple, maybe a demand review meeting, which gives us the forecasting outlook, if we build the capability to also not only forecast the volumes for next few years, but also build a simulation capability to start forecasting what kind of margins it's going to deliver, so on and so forth. So to me, I think unless you build that capability into the processes, we will keep finding it difficult for reaching to the board on the relevant KPIs. So if we like for Henkel, I think we have started with that journey where we are trying to look at how can the processes be seen through to the direct impact on the top line, bottom line, compliances, and the VUCA impact. So that's my 2 bits on this.
Thank you, Vijay. I'm conscious of time. Adarsh and Craig, you have your hands raised, so maybe we can quickly wrap this up.
No, I forgot to lower my hand, so that's
Okay. All right.
Craig.
I think we need to wrap up. Yeah. Maybe very quickly. Yeah, we got 30 seconds more, and then we need to wrap up. Yeah.
I was just going to say, I've just popped a link to a white paper that I actually wrote when I worked for Deloitte on exactly this topic. There's some really useful frameworks in there and thinking about supply chain risk and resilience. I've just popped it in the chat there. Have a look at it. You won't see my name on it, but it was something that I think was written, ironically, in the middle of COVID, and I think those rules still apply. So hopefully you guys will find some use in that.
Yeah. Thank you very much for that PDF. That would be interesting. Okay, so we need to finish this discussion. I'm fully aware that we haven't covered a lot of questions that we prepared. We also had a number of questions from the audience, which we didn't have time to take. So what I recommend is that let's schedule another session. I think risk is something we can talk for probably for another few hours. There's so many angles and so many things we can talk about it. So we will then schedule a session probably in the coming 5 to 6 weeks, and then we'll invite you again, and then we will keep those questions that we haven't answered, and then make sure that we answer them in the next discussion. So thank you again to all of you for taking the time to join this discussion. It was interesting. Thank you, Nanda, Ruth, Arnel, Paul, Vijay, Adarsh, and Craig, and thanks again, Snigdha, for co-hosting this talk with me. It was great having you all. We will share the recording again in the next 24 hours. So if you miss some of it, you can watch the replay on chain.net. And again, we look forward again to see you at our next discussion. Thanks again, and we'll see you next time.
Thanks, everyone.
Thank you.
Thank you.
Thank you.
Bye-bye.
Thank you. Thank you, everybody. Bye-bye.
Thank you.